March 17, 1948, Rome, Italy. Director Giuseppe Marchetti of the Banca d'Italia stood in his ornate office overlooking the Piazza del Popolo, reviewing the economic intelligence report that had arrived that morning from the Ministry of Treasury. His deputy, Carlo Bennedetti, watched as Marchetti read aloud with unmistakable contempt in his voice. The Americans claim their banking system can loan billions of dollars to European nations for reconstruction.
Before we jump back in, tell us where you're tuning in from. And if this story touches you, make sure you're subscribed, because tomorrow I've saved something extra special for you.
Their Federal Reserve suggests individual banks possess lending capacity exceeding Italy's entire national budget. Marchetti set the document down and laughed bitterly. Another American exaggeration. Their banking system is barely 50 years old. Our institutions have financed empires for centuries. What Marchetti did not know, what none of the Italian banking establishment could comprehend, was that at that very moment in New York City, executives at Chase National Bank were finalizing a single loan package worth $2.3 billion to 6 European nations, more capital than every Italian bank combined could mobilize in 5 years. The mathematics of international finance were about to be rewritten by an American banking system that operated on principles Italian bankers considered reckless, maintained reserves that seemed impossibly thin, and could move capital at speeds that defied centuries of European banking tradition. While Italian banks required collateral worth 3 times any loan amount, American institutions were preparing to loan billions based on projected future economic growth and political stability assessments. What the Italian banking director could not grasp was that at that very moment in New York City, executives at Chase National Bank were finalizing a single loan package worth $2.3 billion to 6 European nations, more capital than every Italian bank combined could mobilize in 5 years. The mathematics of international finance were about to be rewritten by an American banking system that operated on principles Italian bankers considered reckless, maintained reserves that seemed impossibly thin, and could move capital at speeds that defied centuries of European banking tradition. The Italian confidence in March 1948 was not mere arrogance. It was based on what appeared to be mathematical and historical certainty. Italian banking institutions traced their lineage to the Medici family of the 15th century. The Banca Monte dei Paschi di Siena, founded in 1472, was the oldest surviving bank in the world. Italian bankers had financed Renaissance art, funded wars, and supported monarchies across Europe for half a millennium. At the heart of this confidence stood the European banking philosophy, which emphasized security, collateral, and conservative lending ratios. Italian banks typically required collateral valued at 250 to 300% of any loan amount. This protected depositors, ensured institutional stability, and prevented the kind of speculative lending that had caused bank failures throughout history. Director Marchetti himself had written extensively on banking theory. His 1938 treatise on collateral requirements had been translated into 6 languages and was required reading at banking institutes across Europe. His philosophy was simple and seemingly unassailable. Capital preservation must always supersede capital growth. Risky lending destroys institutions. Conservative practices ensure survival. The statistics seemed to support this confidence. Italian banks had weathered the global depression of the 1930s better than most American institutions. While thousands of American banks had failed between 1929 and 1933, major Italian banks had remained solvent through strict adherence to collateral requirements and conservative lending practices. The Italian National Banking Association had documented these successes extensively. Their annual reports showed that banks requiring high collateral ratios experienced failure rates below 2%, while American banks with lower collateral standards had failed at rates exceeding 25% during the Depression. The mathematics appeared conclusive. Intelligence reports about American banking capacity seem to confirm Italian superiority through traditional metrics. American banks held reserves averaging only 12% of deposits, a ratio Italian bankers considered dangerously inadequate. European standards required 25 to 30% reserves. The American approach seemed to invite catastrophic failure. Moreover, American lending practices appeared recklessly speculative. Reports indicated that American banks would loan money based on business plans and future earning projections, rather than requiring hard collateral of equal value. Italian bankers viewed this as financial insanity. How could any responsible institution risk depositor capital on hypothetical future earnings? Director Francesco Romano of Credito Italiano, one of Italy's largest commercial banks, had briefed banking executives on American financial weaknesses at a February conference in Milan. The Americans confuse activity with stability. Their high lending volumes create the illusion of strength, but their low reserves and inadequate collateral requirements guarantee eventual collapse. We must resist pressure to adopt their reckless practices. The Italian assessment was not entirely wrong. American banking had experienced spectacular failures. The Depression-era bank runs had destroyed thousands of institutions. The American system appeared volatile, unpredictable, and vulnerable to panic in ways that conservative European banking had largely avoided through stricter requirements and more cautious lending. But what Italian intelligence failed to grasp was the fundamental transformation of American banking philosophy following the Banking Act of 1933 and subsequent reforms. While European banks had responded to the Depression by becoming more conservative, American banks had developed revolutionary methods to mobilize unprecedented capital while managing risk through diversification rather than excessive collateral. At the Federal Reserve headquarters in Washington, economists had been developing what they called liquidity multiplication theory. The concept was revolutionary. Instead of requiring massive collateral for individual loans, banks could achieve safety through portfolio diversification, lending to hundreds of different borrowers across multiple industries and regions. A single loan default would not threaten institutional survival if the portfolio contained sufficient diversity. This approach allowed American banks to maintain lower reserves while actually reducing systemic risk. The mathematics were counterintuitive but powerful. A bank lending to 1,000 borrowers with 12% reserves was more stable than a bank lending to 100 borrowers with 30% reserves, because the diversified portfolio protected against concentrated failures. What Italian bankers dismissed as reckless speculation was actually sophisticated risk management through statistical probability. American banks were not gambling on individual borrowers. They were betting on the mathematical certainty that diversified portfolios would produce predictable overall performance even when individual loans failed. The transformation had begun in 1945, when the Federal Reserve authorized what became known as reconstruction lending protocols. These new guidelines allowed banks to loan based on projected economic recovery rather than current collateral values. The logic was simple, but revolutionary. War-damaged European nations had minimal collateral but enormous reconstruction potential. Loans based on future economic growth could generate returns that traditional collateral-based lending could never achieve. Thomas McKittrick, chairman of Chase National Bank, had become the architect of this revolution. A former international banker who had worked in Europe before the war, McKittrick understood that traditional European banking could never mobilize the capital needed for reconstruction. His philosophy was elegantly simple: loan against future capacity rather than past accumulation. The numbers supported this radical approach. European reconstruction would require an estimated $50 billion over 5 years. No combination of European banks could mobilize even 1/10 of that amount using traditional collateral-based lending. But American banks, using diversification and future value lending, could potentially provide the entire amount. The first major demonstration came on January 15, 1948, when Chase National Bank announced a $400 million loan to France for industrial reconstruction.
Preparing and narrating this story took us a lot of time, so if you are enjoying it, subscribe to our channel. It means a lot to us. Now back to the story.
The loan required collateral of only 40% of the principal amount, a ratio that Italian bankers considered financially suicidal. What followed would revolutionize international finance. The French government used the capital to rebuild manufacturing capacity, which generated tax revenues that easily covered loan payments. Within 18 months, France had repaid the first installments ahead of schedule and was requesting additional capital for expansion. The loan that Italian bankers had predicted would fail spectacularly instead produced returns of 8% annually, while stimulating economic growth that created additional lending opportunities. Director Marchetti, reading reports of the French loan's success, remained skeptical. He circulated a memo to Italian banking executives warning against interpreting a single success as proof of concept. "One favorable outcome does not validate reckless lending practices," he wrote. "We must maintain our standards regardless of temporary American successes."
The Italian banking establishment's confidence in their methods was built upon centuries of documented success and mathematical principles that seemed irrefutable. When Director Marchetti dismissed American lending capacity, he was not speaking from ignorance, but from deep institutional knowledge that had survived wars, plagues, economic collapses, and political revolutions. The Banca d'Italia archives contained lending records dating back to the Renaissance, showing how conservative practices had protected depositor wealth through every conceivable crisis. Professor Alberto Fontana, who held the chair of banking theory at the University of Bologna, had spent his career studying the relationship between collateral requirements and institutional survival. His research, published in the prestigious Journal of European Finance in 1946, demonstrated that banks maintaining collateral ratios above 250% experienced failure rates of less than 1.5% over century-long periods. Banks with lower ratios showed exponentially higher failure rates. The mathematics were clear and historically validated. High collateral requirements were not conservative caution, but mathematical necessity. The Italian banking curriculum, taught at universities across the nation, emphasized these principles as fundamental law. Students learned that the primary obligation of any banker was capital preservation, not capital growth. Lending was a sacred trust between depositor and institution. Reckless lending that risked depositor capital was not merely poor business practice, but a moral failing that violated centuries of banking ethics. Director Marchetti himself had begun his career in 1922 at Banco di Roma, working his way through every department before assuming leadership positions. His first-hand experience during the global depression had reinforced his conviction that conservative lending was the only sustainable approach. He had witnessed American banks collapse while Italian institutions remained solvent precisely because Italian banks had maintained higher standards. The numbers from the Depression era told a stark story. Between 1929 and 1933, over 9,000 American banks had failed, wiping out the savings of millions of depositors. During the same period, Italian banks experienced fewer than 40 failures, and most of those were small regional institutions that had violated standard collateral requirements. The Italian Banking Association had published these statistics extensively, using them to justify resistance to American-style lending practices. The evidence seemed overwhelming. Conservative lending worked. Speculative lending failed. Any attempt to deviate from proven principles would inevitably lead to disaster. The Italian Central Banking Authority had codified these principles into regulations that all commercial banks were required to follow. Commercial loans required collateral valued at minimum 250% of principal. Industrial loans required 300% collateral. International loans required 350% collateral plus government guarantees. These regulations were not arbitrary, but based on statistical analysis of centuries of banking operations. European banking conferences reinforced these principles through regular meetings where Italian, French, German, and Swiss bankers shared experiences and validated each other's conservative approaches. The 1947 European Banking Summit in Zurich had produced a joint declaration reaffirming commitment to high collateral standards and rejecting pressure to adopt American lending practices. 73 banks from 12 nations had signed the declaration. Director Romano of Credito Italiano had been particularly vocal at the Zurich summit, presenting data showing that American banks held average reserves of only 11.3% compared to European averages of 27.8%. His presentation concluded with a warning that would later prove tragically ironic. The Americans are building a house of cards. Their low reserves and inadequate collateral requirements create the illusion of strength through high lending volumes, but this structure will collapse at the first sign of economic stress, just as it did in 1929. We must resist their pressure to compromise our standards. The Italian banking press echoed these sentiments. Il Sole 24 Ore, Italy's leading financial newspaper, published regular editorials praising Italian banking conservatism and criticizing American speculation. A February 1948 editorial titled "The Folly of American Finance" argued that American lending practices represented a dangerous regression to the kind of speculative excess that had caused the Depression. Our banks have survived for centuries by adhering to principles the Americans seem determined to ignore, the editorial concluded. When their system collapses again, as it inevitably will, Italian banks will remain stable because we never abandon the wisdom of experience for the illusion of innovation. The mathematical logic supporting Italian confidence extended beyond simple failure rate comparisons. Italian banking theorists had developed sophisticated models showing why high collateral requirements were mathematically necessary for long-term stability. Professor Fontana's most influential work, The Mathematics of Banking Survival, demonstrated that loan portfolios required collateral buffers to absorb normal variation in collateral values during economic cycles. His calculations showed that collateral valued at 250% of loan principal provided adequate protection against the normal 30 to 40% variation in asset values during economic cycles. Lower collateral ratios left banks vulnerable to normal market fluctuations, creating systemic instability even without major economic crises. These models were not theoretical abstractions, but practical tools used by Italian banks to manage risk. Every loan officer was trained in calculating appropriate collateral ratios based on asset volatility and economic conditions. The system had worked flawlessly for generations, producing stable institutions that served their communities reliably through all economic conditions. The Italian Ministry of Treasury had conducted its own analysis of American banking capacity and concluded that American claims about billion-dollar lending capability were likely exaggerated or based on accounting methods that obscured real financial positions. A classified report prepared for the Italian cabinet in February 1948 stated that while American banks might claim high lending capacity, their actual ability to sustain large international loans was questionable given their low reserve ratios and minimal collateral requirements. Minister of Treasury Giovanni Pella had personally reviewed the American banking data and concluded that Italian banks should maintain current practices regardless of American pressure. In a memo to Prime Minister Alcide de Gasperi, Pella wrote that the Americans are offering what appears to be easy capital, but their lending terms violate every principle of sound banking. We should seek reconstruction funds from sources that operate on sustainable financial principles rather than compromising our banking system's integrity for short-term capital access. This official government position reinforced the banking establishment's resistance to American methods. Italian banks were not simply being stubborn or prideful, they were following official policy based on what appeared to be sound financial analysis and historical evidence. The confidence extended to Italy's relationship with the International Monetary Fund and World Bank, institutions where Italian economists held influential positions. Italian representatives consistently argued for conservative lending standards in international institutions, warning against the kind of speculative lending that American banks seemed to be promoting. Dr. Guido Carli, who would later become governor of the Banca d'Italia, was serving as an IMF economist in 1948. His internal memos warned that American enthusiasm for large-scale reconstruction lending without adequate collateral could destabilize international financial systems. We must ensure that international lending institutions maintain sound practices even if individual American banks choose to pursue reckless policies, he wrote in a March 1948 memo that circulated among European central bankers. While Italian bankers were reinforcing centuries-old practices in Rome and Milan, a quiet revolution was transforming American banking in ways that traditional European analysis could not comprehend. The transformation had not begun with dramatic announcements or theoretical manifestos, but with practical necessity born from the catastrophic banking failures of the Great Depression. The architects of this revolution understood that American banking had to evolve or become irrelevant to post-war economic realities. At the Federal Reserve Bank of New York, a team of economists led by Dr. Robert Warren had been developing what they called portfolio theory, a mathematical framework that would fundamentally change how banks assessed and managed risk. Warren, a former mathematics professor from MIT who had joined the Fed in 1940, approached banking not as a moral exercise in capital preservation, but as a statistical problem in probability management. His insight was deceptively simple, but mathematically powerful. Risk in lending came not from individual loan characteristics, but from portfolio composition. A bank could safely operate with lower reserves and reduced collateral requirements if its loan portfolio was sufficiently diversified across industries, geographic regions, and borrower types. The mathematics proved that a diversified portfolio of 1,000 loans with 15% reserves was statistically safer than a concentrated portfolio of 100 loans with 30% reserves. The probability of catastrophic loss decreased exponentially as portfolio diversity increased, even when individual loan risk increased moderately. This insight overturned 5 centuries of European banking wisdom. Italian bankers assessed each loan individually, requiring massive collateral to protect against individual defaults. American bankers were learning to assess portfolios statistically, understanding that individual defaults were not threats, but mathematical certainties to be absorbed by overall portfolio performance. Thomas McKittrick at Chase National Bank had been one of the first senior bankers to fully embrace portfolio theory. His background was unusual for American banking. He had spent 15 years working for the Bank for International Settlements in Basel, Switzerland, giving him deep understanding of European banking practices. But his experience had led him to conclude that European methods, however historically successful, were inadequate for modern economic requirements. McKittrick's philosophy was revolutionary. Banks should not ask whether an individual borrower might default. They should ask whether a portfolio of similar loans would generate positive returns after absorbing statistically predictable defaults. This shift from individual assessment to statistical portfolio management allowed American banks to loan far more capital with actually lower systemic risk than conservative European approaches. The first large-scale test of this approach had come in 1946 with domestic lending programs. Chase National Bank created a small business loan program that would have horrified Italian banking regulators. The program offered loans with collateral requirements as low as 80% of principal, far below the 250% European standard. Individual loans were limited to $50,000 to prevent concentrated risk. Chase created a portfolio of 2,400 small business loans, totaling $84 million. Traditional banking analysis predicted disaster. With such low collateral requirements, even a 10% default rate would cause significant losses. But portfolio theory predicted something different. The 2,400 loans were distributed across 340 different industries in 47 states. No single industry represented more than 4% of the portfolio. No single state represented more than 8%. This distribution meant that regional economic problems or industry-specific difficulties would affect only small portions of the portfolio. The results validated portfolio theory spectacularly. After 2 years, the default rate was 6.8%, within predicted parameters. But the diversification meant that defaults were scattered across the portfolio with no concentrated impact. The program generated returns of 7.2% annually, far exceeding what conservative lending with high collateral requirements could achieve. More importantly, the 2,400 businesses that received loans created an estimated 18,000 jobs and generated significant economic activity that produced additional lending opportunities. McKittrick presented these results at a restricted briefing for Federal Reserve officials and major bank executives in December 1947. His presentation included a comparison that made the revolutionary implications clear. Traditional European bank lending $84 million at 250% collateral requirements could support perhaps 400 loans because borrowers who could provide such massive collateral were rare. The concentrated portfolio of 400 loans to wealthy borrowers was actually riskier than Chase's diversified portfolio of 2,400 loans to smaller borrowers, because any problem affecting wealthy borrowers would impact a significant percentage of the portfolio. The Federal Reserve officials at that briefing understood they were witnessing a fundamental transformation in banking mathematics. Alan Sproul, president of the New York Fed, summarized the implications in his diary that evening. "We have discovered that the old European certainties about collateral and reserves were not wrong, but incomplete. They protected individual institutions, but limited systemic capacity. Portfolio diversification allows us to mobilize far more capital with actually lower systemic risk. This changes everything about international lending capacity." The revolution accelerated in early 1948 when the Marshall Plan created demand for unprecedented international lending. European reconstruction would require billions of dollars in loans to governments and businesses that had been devastated by war. Traditional collateral-based lending could not possibly meet this demand because war-damaged nations had minimal collateral to offer. American banks faced a choice. They could maintain conservative practices and remain irrelevant to reconstruction, or they could apply portfolio theory to international lending and mobilize the capital Europe desperately needed. The decision was not purely altruistic. Banks that financed reconstruction would gain dominant positions in rebuilding European economies, creating long-term competitive advantages worth far more than the fees from any individual loans. McKittrick convened a meeting of the 7 largest American banks in January 1948 to coordinate an approach to reconstruction lending. The meeting, held at the Metropolitan Club in New York, brought together the leaders of Chase National, National City Bank, Bank of America, Guaranty Trust, Bankers Trust, J.P. Morgan, and First National Bank of Boston. The combined assets of these institutions exceeded $35 billion, larger than the entire banking systems of France, Italy, and Belgium combined. McKittrick's proposal was audacious. Create a coordinated portfolio of reconstruction loans to European governments and major European corporations. Require collateral of only 50 to 75% of principal, far below European standards. Distribute loans across multiple countries and industries to achieve portfolio diversification. The total lending package would reach $8 billion over 3 years, more capital than European banks could mobilize in a decade. The mathematics of the proposal shocked even the American bankers present. John McCloy of Chase National questioned whether any collection of banks could sustain such lending with such low collateral. McKittrick's response revealed the paradigm shift. We are not making $8 billion worth of individual loans. We are creating a portfolio investment in European economic recovery. The statistical probability of total portfolio failure is virtually zero because European economies will not all fail simultaneously.
Individual loan defaults are certain, but irrelevant to overall portfolio performance. The banks agreed to the coordinated lending program with one condition. They would start with a demonstration loan to a single country to validate the portfolio theory in international contexts. France, with its combination of industrial capacity and political stability, was selected for the first test. On January 15, 1948, Chase National Bank announced a $400 million loan to the French government for industrial reconstruction. The terms shocked European banking establishments. Collateral requirements were set at just 40% of principal. Interest rates were 4.5% annually, barely above the risk-free rate for U.S. government bonds. Repayment would be spread over 15 years, an unprecedented term for such a large international loan. Italian banking journals published scathing criticisms. Il Sole 24 Ore called the loan a reckless gamble that violates every principle of sound international finance. Director Marchetti issued a statement predicting the loan would default within 3 years, causing significant losses for American depositors and validating European conservative practices. But what Italian critics did not understand was the sophisticated risk analysis underlying the loan. Chase's team had calculated that France needed the capital to rebuild industrial capacity. That rebuilt capacity would generate tax revenues far exceeding loan payments. The low interest rate made repayment easily manageable from projected revenues. The extended term reduced annual payment burden to levels that statistical analysis showed France could sustain even under pessimistic economic scenarios. Moreover, the loan was structured with covenants that gave Chase unprecedented insight into French economic management. The success of the French loan in summer 1948 triggered a cascade of American banking operations that would systematically dismantle European financial dominance. What Italian bankers had dismissed as a lucky anomaly was actually the first demonstration of a coordinated strategy that would fundamentally reshape international finance. By August 1948, the consortium of 7 American banks had approved reconstruction loans totaling $1.8 billion to 4 additional countries. The Netherlands received $340 million for port reconstruction and shipping industry revival. Belgium secured $280 million for steel industry modernization. Denmark obtained $190 million for agricultural mechanization and food processing facilities. Norway was granted $220 million for rebuilding its merchant marine fleet. Each loan followed the portfolio theory framework with collateral requirements between 40% and 60% of principal, terms that Italian banking regulations would never permit. Director Marchetti, monitoring these developments from Rome, convened an emergency meeting of the Italian Banking Association Council in September. His presentation to the 37-member banks revealed growing alarm beneath his maintained confidence. The Americans have now committed nearly $2.2 billion to European reconstruction, using lending standards we consider inadequate. While we must acknowledge that early repayment performance has been positive, we cannot abandon centuries of proven practice based on 18 months of results. However, we must also recognize that American banks are establishing relationships and influence across Europe that may disadvantage Italian institutions in the long term. The psychological impact was beginning to manifest in ways that transcended mere financial competition. Italian corporations seeking capital from modernization were increasingly approaching American banks rather than domestic institutions because American terms were far more favorable. Fiat Automobile Company shocked the Italian banking establishment in October 1948 by securing a $45 million loan from Bank of America rather than its traditional Italian banking partners. The loan required collateral of only 55% of principal and carried an interest rate 2 percentage points below what Italian banks could offer. Giovanni Agnelli, Fiat's chairman, explained the decision in terms that revealed the transformation underway. Italian banks wanted us to pledge assets worth 3 times the loan amount and demanded repayment in 7 years. Bank of America accepted collateral of barely half the loan value and gave us 15 years to repay. The choice was obvious. We are building Italy's industrial future. We cannot do that while meeting collateral requirements designed for medieval merchant banking. The November defection of Montecatini Chemical Company to American financing proved even more significant.
Montecatini was one of Italy's largest industrial corporations with deep historical ties to Italian banks. When the company secured an $80 million loan from National City Bank with only 50% collateral requirements, it sent shockwaves through the Italian banking community. Director Romano of Credito Italiano issued a public statement warning that Italian corporations were mortgaging their independence to American financial institutions. But his warning rang hollow because Italian banks could not match American terms without abandoning the regulatory framework and risk management principles that defined their institutional identity. By December 1948, American banks had committed over $3.4 billion to European reconstruction and corporate financing. The scale exceeded anything Italian banking analysis had predicted was possible. More troubling for European banks was the performance data. Default rates remained below 2%. Repayment schedules were being met or exceeded. The portfolio theory that Italian bankers had dismissed as reckless speculation was producing better results than conservative European lending. The Italian Ministry of Treasury commissioned a comprehensive analysis of American banking operations in January 1949. The classified report prepared by a team of economists and banking experts concluded that American banks had indeed developed fundamentally different risk management capabilities that allowed sustainable lending at scales and terms Italian banks could not match. The report's most disturbing conclusion stated that unless Italian banks adapted their practices, they would become irrelevant to Italy's reconstruction and modernization. The psychological toll on Italian banking leadership became evident in private correspondence preserved in banking archives. Director Marchetti wrote to his longtime colleague at Banca Commerciale Italiana in February 1949 with unmistakable despair. "We were right about the mathematics of traditional banking. Our collateral requirements and reserve ratios do protect individual institutions from failure. But the Americans have shown that protecting individual institutions is less important than mobilizing capital for economic growth. They are willing to accept higher individual loan risk because their portfolio diversification makes systemic failure statistically impossible. We chose safety, they chose growth, and growth is winning." The March 1949 announcement of the European Recovery Program loans marked the point where American financial dominance became mathematically irreversible. The Marshall Plan authorized American banks to loan up to $12 billion over 4 years for European reconstruction. The consortium of American banks immediately announced they could provide the entire amount through coordinated portfolio lending. No combination of European banks could mobilize even 1/4 of that capital using traditional practices. Italian banks faced an existential crisis. They could maintain their conservative principles and become marginal players in their own country's reconstruction, or they could attempt to adopt American methods and risk institutional failure if the portfolio theory proved unsustainable in the long term. The April meeting of European central bank governors in Basel revealed the depth of the transformation. Representatives from 12 European nations gathered to discuss coordinated response to American banking dominance. The discussions, recorded in confidential minutes, showed that European banking leadership now understood they had fundamentally misread the situation. Dr. Guido Carli, representing Italy at the meeting, delivered a presentation that acknowledged what Italian bankers had refused to accept for 18 months. The Americans have not been lucky or reckless. They have developed a mathematically superior framework for assessing and managing lending risk. Their portfolio diversification approach allows them to operate safely with lower reserves and collateral requirements than our traditional methods permit. We face a choice between adapting our practices or accepting permanent subordination in international finance. The Basel meeting produced no coordinated European response because no response was mathematically possible. European banks could not suddenly acquire the scale, diversification, and statistical expertise that American banks had developed over years. The institutional knowledge, risk assessment frameworks, and operational systems required for portfolio-based lending could not be quickly replicated. By May 1949, Italian corporations had secured over $380 million in loans from American banks, capital that would have required $950 million in collateral under Italian banking regulations. Italian banks watched helplessly as their traditional corporate clients defected to American financing that was simply too favorable to refuse. The psychological impact extended beyond banking professionals to Italian government officials and economic planners. Prime Minister De Gasperi, who had initially supported the banking establishment's resistance to American methods, was forced to acknowledge in a June cabinet meeting that Italian reconstruction was being financed primarily by American banks because Italian institutions could not provide necessary capital on competitive terms. The June announcement that General Motors would finance construction of a major Italian manufacturing facility entirely through American bank loans rather than Italian financing marked a symbolic turning point. American banks were not just financing Italian reconstruction, but were becoming the primary capital providers for Italy's industrial future. The July defection of 3 mid-size Italian banks from traditional practices demonstrated that the transformation was becoming systemic. These banks announced they would begin offering loans with reduced collateral requirements based on portfolio risk assessment rather than individual loan security. The Italian Banking Association condemned these defections as violations of sound banking principles. But the condemnation carried no weight because the defecting banks were responding to competitive reality rather than theoretical principle. August brought the revelation that American banks were now actively recruiting Italian banking professionals with offers of salaries 3 to 4 times what Italian institutions paid. Dozens of young Italian economists and loan officers emigrated to New York to work for American banks, taking with them knowledge of Italian markets and corporate relationships that would further advantage American institutions. By September 1949, American banks had committed over $7.2 billion to European reconstruction and corporate financing. The scale was so vast that Italian banking statistics no longer provided meaningful comparison. The entire Italian banking system held total assets of approximately $4.8 billion. American banks were lending more capital to Europe annually than Italian banks held in total assets accumulated over centuries. The October financial reports from Italian banks showed the material impact of American competition. Loan volumes had declined 23% compared to the previous year. Interest income had fallen 31% because the most profitable corporate clients had shifted to American financing. Several regional banks reported operating losses for the first time in their histories. Director Marchetti, the same banking official who had confidently dismissed American capabilities 18 months earlier, submitted his resignation from Banca d'Italia in November 1949. His resignation letter, preserved in banking archives, acknowledged the magnitude of his miscalculation. I believed that centuries of Italian banking.
By January 1950, the transformation of international banking was complete and irreversible. American banks had committed over $14.3 billion to European reconstruction and corporate financing over a 24-month period, a sum that exceeded the combined lending capacity of all European banks operating under traditional practices. The statistical performance of this unprecedented lending program had validated portfolio theory beyond any reasonable dispute. Default rates across the entire American lending portfolio stood at 2.1%, well below the 3 to 5% that portfolio theory had predicted as acceptable. More significantly, the diversified lending approach had prevented any single default from creating systemic problems. When a textile manufacturer in Belgium defaulted on a $3.2 million loan in December 1949, the loss represented only 0.02% of the total American lending portfolio and was easily absorbed by overall returns. Under traditional Italian banking concentration, a single default of that magnitude would have represented a significant institutional crisis requiring board intervention and regulatory review. The mathematical superiority of diversified portfolio lending over concentrated collateral-based lending had been demonstrated with scientific precision. European reconstruction proceeded at rates that economic historians would later identify as unprecedented in human history. Italian industrial production in 1950 exceeded pre-war levels by 34%, growth financed almost entirely by American bank loans that Italian banks could not have provided under their traditional practices. The fiat loans had enabled production capacity increases of 340%. Montecontini's American financing had funded chemical plants that made Italy self-sufficient in industrial materials for the first time. Dozens of smaller Italian manufacturers had modernized using American capital that required collateral Italian banks would never have accepted. The human dimension of this transformation extended beyond statistics to fundamental changes in how Italians understood economic possibility. A generation of Italian business leaders learned that growth was possible without inherited wealth or massive collateral. American-style lending, based on business potential rather than existing assets, democratized access to capital in ways that centuries of Italian banking tradition had never permitted. Young Italian entrepreneurs who would have been excluded from traditional bank financing secured American loans based on business plans and growth projections. This created an explosion of small business formation that transformed Italian economic structure. Between 1948 and 1952, over 4,700 new Italian businesses were started using American bank financing, creating an estimated 87,000 jobs and fundamentally altering Italy's economic landscape. Conversely, the Italian banking establishment emerged from this period permanently diminished. The Banca d'Italia was forced to revise its collateral requirements in March 1950, reducing mandatory ratios from 250% to 150% in a desperate attempt to remain competitive. But the revision came too late and went too little toward matching American terms. Italian banks had lost their premier corporate clients and would spend decades trying to rebuild relationships that American banks now dominated. The psychological trauma within Italian banking leadership proved deep and lasting. Professor Fontana, whose mathematical models had provided theoretical justification for high collateral requirements, suffered a nervous breakdown in April 1950 and never returned to teaching. His life's work had been invalidated not through theoretical argument, but through practical demonstration that his mathematics, however internally consistent, described a system that was no longer optimal for modern economic requirements. Director Romano, who had warned so confidently about American recklessness at the 1947 Zurich Banking Summit, accepted a position as a consultant to Chase National Bank in 1951, effectively acknowledging that if he could not defeat American banking methods, he would join them. His hiring was symbolic of a broader brain drain as Italian banking talent emigrated to American institutions that offered both higher compensation and intellectually superior frameworks for understanding modern finance. The strategic implications extended far beyond banking to fundamental questions of economic power and national independence. American banks' dominance of European reconstruction financing gave the United States unprecedented influence over European economic development. The banks that financed Italy's industrial revival gained insight into Italian corporate strategy, access to Italian markets, and relationships with Italian business leaders that would shape economic relations for generations. The Marshall Plan loans demonstrated that precision capital deployment could achieve strategic objectives without military force or political coercion. Transportation systems, communication networks, and industrial facilities rebuilt with American bank financing created dependencies and relationships that proved more durable than any occupation could have achieved. Economic integration through lending proved more effective than political control through conquest. The irony that Italian banking leaders gradually came to understand was that every criticism they had leveled against American banking methods had been simultaneously correct and irrelevant. American banks did maintain lower reserves than European standards recommended. They did accept collateral that Italian regulations would have prohibited. They did loan based on projections rather than demonstrated capacity. But all these apparent weaknesses proved to be strengths in a transformed economic context where capital mobilization mattered more than capital preservation, where growth potential outweighed historical performance, and where statistical portfolio management superseded individual loan security.
The production statistics tell the story with undeniable clarity. In 1947, before American portfolio lending began, European industrial production stood at 63% of pre-war levels. By 1952, after 4 years of American bank financing, European production exceeded pre-war levels by 41%. The capital that enabled this recovery came almost entirely from American banks, using methods that Italian banks had confidently dismissed as reckless speculation. The final irony of the story lies in subsequent Italian adoption of American banking methods. By 1955, Italian banks were offering loans with collateral requirements of 100% or less, terms they had condemned as financially suicidal just 7 years earlier. The mathematical models that Professor Fontana had used to prove high collateral requirements were necessary had been replaced by portfolio theory frameworks copied directly from American banking practice. When Director Marchetti died in 1964, His obituary in Il Sole 24 Ore acknowledged his distinguished career, but noted that his resistance to American banking innovations had contributed to Italian banking's loss of dominance in European finance. The assessment was diplomatic, but clear. Marchetti had been a competent banker, operating with principles that were no longer adequate to modern requirements. His failure was not of character or intelligence, but of adaptability. The American consortium banks that had revolutionized international lending in 1948-1950 evolved into the dominant global financial institutions of the late 20th century. Chase Manhattan, Citibank, and Bank of America became household names worldwide, their dominance built on the portfolio theory foundations laid during European reconstruction. Italian banks that had once traced their lineage to the Medicis became regional players in a global financial system defined by American innovations. Herman Abs, reflecting on the transformation in his later years, provided perhaps the most elegant summary of what had occurred. The Americans won not because they were reckless, but because they were right. They understood that in a world requiring unprecedented capital mobilization, the side that could deploy capital most efficiently would dominate, regardless of traditional practices or historical precedent. Italian banks chose to be right about old principles. American banks chose to be effective with new principles. Effectiveness won. When Italian banking officials first read intelligence reports about American banks claiming ability to loan billions of dollars with minimal collateral, they dismissed the claims as American exaggeration typical of a young nation without proper banking tradition. By 1950, they understood they had been witnessing not American boasting, but American revolution. The United States had indeed created a banking system that could loan billions safely and profitably, and European banking traditions had stood no chance against such focused mathematical superiority. The final accounting showed that American banks had loaned $14.3 billion to European reconstruction between 1948 and 1950. Italian banks, operating under practices they had confidently defended as superior, had provided less than $400 million during the same period. The mathematical gap was not just large, but decisive. One banking philosophy mobilized capital that rebuilt a continent. The other had preserved capital that became irrelevant to the transformation it could not finance. The story of Italian banking's confrontation with American financial innovation remains a powerful reminder that institutional confidence based on historical success provides no protection against fundamental changes in competitive requirements. Sometimes, the most dangerous position is not being wrong, but being right about principles that no longer apply to changed reality.
Up next, you've got two more standout stories right on your screen. If this one hit the mark, you won't want to pass these up. Just click and check them out. And don't forget to subscribe and turn on the notification bell so you don't miss any upload from us.